Chapter 12, Revenue and Inventory Fraud, presented by Nastasha Farley and Megan Porter. Revenue-related fraud occurs due to 1. The availability of acceptable alternatives for recognizing revenue, and 2. The ease of manipulating net income using revenue and receivable accounts. According to a study done by the Committee of Sponsoring Organizations, recording fictitious revenues was the most common way to manipulate revenue accounts, and recording revenues prematurely was the second most common way. Barry Minko of the ZZ Best Fraud. Receivables are a wonderful thing. You create a receivable and you have revenue. Here is the basic flow of revenue-related transactions. In each step, there are specific revenue-related accounts and fraud schemes that could occur. For example, during step 5, collect cash, both cash and accounts receivable are involved. An example of fraud here could be manipulating cash received from related parties, also known as lapping. Here are some of the most common revenue-related fraud schemes. All of these fraud schemes result in overstated revenues and overstated net income. There are 6 revenue-related fraud symptoms. Analytical symptoms are economic events, accounting transactions, or financial and non-financial relationships that are unusual. Accounting or documentary symptoms are discrepancy in the accounting records or system and involve such things as missing documents, photocopies where originals should exist, and ledgers that do not balance. When looking for lifestyle symptoms, you need to notice if the perpetrator started to improve their lifestyle. Control symptoms are breakdowns in the control environment, accounting system, or internal control activities or procedures that are often so egregious that they hint that management is overriding key controls. An example here is the Citigroup case, where the manager was overriding the controls for unapproved vendors. Behavioral and verbal symptoms occur when fraud perpetrators change their behavior to cope with stress or hide fraud symptoms. Finally, be open to tips and complaints from employees, spouses, vendors, customers, and others. When searching for analytical symptoms, you should 1. Look for unusual changes in revenue-related account balances and relationships from period to period. 2. Compare financial statement amounts or relationships with information outside the financial statements. To determine whether analytical systems exist, a point of reference, an exception, or some reasonable balance relationship to which recorded amounts can be compared to is necessary. Here are 3 ways to look for unusual changes in revenue-related accounts. Calculate changes in the actual financial statements, use horizontal analysis, or study the cash flow statement. From Chapter 6, we learned that horizontal analysis is a method involving examining percentage changes in account balances from period to period on the income statement and balance statement. This is typically the most effective way. There are 2 ways to look for changes in revenue relationships. The first way is to focus on changes in various revenue-related ratios from period to period. The most common ratios used to discover revenue-related analytical fraud symptoms are listed below. The key to using these ratios is to look at changes and speed of changes in the ratio. It is not necessarily about the size and direction of the change. The second way to look at relationships is to perform vertical analysis. This analysis allows you to simultaneously view the relationships between all numbers on the balance sheet or income statement. Developing a reliable expectation or prediction regarding what the relationship or ratio should look like is the most important step in this process. To find unusual amounts and relationships within the financial statements, we need to compare financial statement information to a company in the same industry. It is also important to compare recorded amounts in the financial statements with real-world assets to detect fraud. With each of these options for looking into analytical symptoms of fraud, it is much easier to work with percentages than with raw data. One of the most common ways for management to commit fraud is through posting one or more journal entry directly to the accounting records. These entries are typically known as top-side journal entries. Journal entries need to be analyzed based on the 5 W's. Who posted the entry, what the entry was for, when the entry was posted, where the entry was posted in the accounting system, why the entry was posted. Key red flags include entries posted outside of normal business hours, large round number entries made by the CFO. When looking for control symptoms, we need to review the fraud triangle. When an organization is experiencing pressures and management rationalizes that the pressures are only short-term and will correct themselves in the future, it is important to look closely at the internal controls. If there is a control breakdown, management is more likely to take advantage and commit fraud. The Sarbanes-Oxley Act has helped eliminate weak audit committees in public companies, but there are still many weak or non-existent audit committees in non-public companies. With financial statement fraud, perpetrators benefit indirectly as the company has a higher stock price or getting a higher bonus based on fictitious financial results. When questioning management, the key is to listen for inconsistencies. It takes significant effort and a good memory to consistently lie. Actively searching for tips and complaints includes anonymous hotlines and the whistleblower system, which is required for all public companies in the United States. Here are a few real-world examples. Kmart inflated revenue by improperly recognizing an entire $42.3 million in revenue from a multi-year contract in the second quarter of 2001. They declared bankruptcy in January 2002, and 2 former VPs were charged with earnings fraud. In the Sunbeam court case, they created $35 million in inappropriate restructuring reserves and reported over $70 million of revenue from bill and hold sales, channel stuffing, and other inappropriate accounting practices. The CEO was charged with violating federal security laws by misrepresenting material information about the company. The CEO settled by paying a piece of the $141 million fine.
Inventory and cost of goods sold fraud. This is the next most common type of financial statement fraud after revenue-related frauds. It involves manipulation of inventory and cost of goods sold accounts. Rite Aid Corporation was a fitting example of both frauds mentioned. CEO Martin Grass was found to have overstated net income by managing the value of Rite Aid inventory. He did so by failing to record millions of dollars due to shrinkage, and he would also make topside journal entries to lower the cost of goods sold. According to various online articles, the fraud was said to have stemmed from the interest on Rite Aid's debt beginning to choke out profits and hold down its stock price. In Chapter 11 of the textbook, it mentions fraud elements and elements number 5 being high debt levels. This element was dominant in Rite Aid's fraud. For one to understand why inventory-related fraud is so common, one must understand the relationship between inventory and the income statement. If inventory at the end of the period is overstated, cost of goods sold is understated, and gross margin and net income are overstated by an equal amount. Cost of goods sold can be understated by either understating purchases, overstating inventory, overstating purchase returns, or purchase discounts. Overstating inventory is the most common because it increases net income and assets to make the balance sheet appear better than what it really is. Fraud by overstating inventory is very difficult to maintain without being caught. This is because overstated inventory becomes beginning inventory in the next period, which causes net income to be overstated. This reversing effect in the subsequent period would mean that if the perpetrator wanted to fraudulently increase net income in the second period, he must first commit a fraud for the equivalent amount to offset the overstated beginning balance. Then he would need to commit an additional fraud to increase net income. The compounding effect from period to period forces the perpetrator to continue the fraud. Overstating inventory for this reason hardly ever is a one-time action. This continues until the overstatement becomes so big that it is detected. These are several different types of inventory-related fraud exposures. A couple of examples are double counting and overestimating inventory. Double counting occurs when inventory items are counted twice, such as in the case where inventory has been moved to another location, but counted for the second time. Overestimating inventory could be the result of applying an incorrect sampling method. However, a company could use these incorrect methods intentionally to overstate ending inventory. One of the best ways to identify financial statement fraud exposures involving inventory is to map out all the inventory-related transactions that can occur in an organization, such as shown in the table here. Now that you have the 9 different transactions mapped out, the next step is to brainstorm the different accounts related to these transactions, and the possible fraud schemes that could occur in each of these transactions. Here are some examples of analytical and accounting or documentary symptoms for inventory-related fraud. One documentary symptom is vendors not listed in Dun & Bradstreet. This was a fraud symptom that tipped off McKesson's and Robbins' company treasurer, Julian Thompson. Thompson became suspicious of large payments made to W.W. Smith Co., which is an analytical symptom. Thompson pulled their D&B credit report and took it to a D&B representative for verification. There he learned that the reports were forged and fake. This led to an investigation into McKesson and Robbins' accounting practices, and it was later found that the company's balance sheet was made up of $19 million of fictitious inventory, masterminded by Philip Musica. This fraud was monumental for the accounting industry because it led to the adoption of GAAP, including the concept of an independent audit. It also required auditors to personally observe and inspect inventory to verify its existence. Behavioral and verbal symptoms, control and lifestyle symptoms, as well as tips and complaints are also similar to revenue-related frauds, but as it relates to inventory. While searching for inventory and cost of goods sold analytical symptoms, they are also similar to searching for revenue-related fraud symptoms. But as stated before, the most effective method to examining changes would be to use horizontal analysis. However, the least effective method is to focus on changes in the financial statements amount. This is because the amounts inherently are large and it will be difficult to assess change and to classify any as significant based on numbers alone. Again, it is not the change itself that signals fraud, but the pace of the change. The faster and more dramatic, the more likely the chance that fraud is occurring. Below is a list of ratios and methods one could use to search for inventory and cost of goods sold analytical symptoms. When actively searching for inventory-related control symptoms, there are some concerns with controls over purchasing process, receiving, recording of liabilities, and cash disbursements. 2. Ensure recorded inventory represents goods received, transaction amounts are accurate, properly classified, and recorded in the proper period and in the correct amounts. Actively searching for behavioral, verbal, or lifestyle symptoms are not very effective because financial statement frauds usually do not benefit perpetrators directly. Auditors and fraud examiners may ask questions about inventory levels, and changes in vendors. While asking questions, the auditor should pay attention to any inconsistencies between what is said by management and what is observed. Tips and complaints. Because of the physical nature of inventory, this requires people and manpower. Talking to ones who handle the inventory may reveal useful information if the right questions are asked. Contacting vendors to determine their relationship with the company may be helpful as well as contacting customers and assessing inventory quality and product returns.